Hello, this is a TSO trade, and today I'm gonna go over a newly released indicator. It's specifically for selling options. It could be used for uh, similar, simple, regular approaches, and it can be used with a smart strategy approach, which I'll go over as well. Before anything, let me go real quick over what options are. I did include put together the whole section explaining how options work, what they are, how people trade them. You can find it all in TSO.trade, options trading indicator. On here it simply explains advantages of trading with covered options versus simply trading stocks or simply options. Um, and in here I tried to put this as much as possible within my own words, to make it as short as possible, as options are a complicated overall thing. They're dangerous. You can easily wipe out huge amounts of money in seconds, so you gotta know what you're doing. uh, I'm not gonna go over the whole thing, but I'm just gonna go over the basics and go over options basic examples, and then further on I'll go over smart strategy approaches which I put together. So an option is a contract sold from seller, who sometimes is called writer, to buyer, which gives buyer the right but not obligation to purchase a stock at a specific price, which is strike. Now, if stock price, once the options are sold, if stock price is getting closer or breaking beyond the strike, option contracts increase in value. If stock price goes away from the strike, options contracts decrease in value. And strike, depending on the direction and option type, it could be up or could be down. That's why I'm wording it close or away, beyond, and such, because it's not always up or down. I mean, it is up or down, but uh, it may mean different things. Uh, so, uh, so there is a strike, and besides the strike, there is a expiration date. And once the options are sold, the closer the expiration date is, the lower the value of the option contract is, which is called options time decay. So, depending on the expiration date, options lose value. And once they expire, they become completely worthless. And just as an example, for example, index like S&P 500, there are options which expire the same day. If you, for example, you buy that option, and in like 3 hours it goes, it's not going anywhere, you can lose up to like 30-40%. Just the market is not going anywhere, you're already losing like 30-40%. Of course, though, if it's several days or a week, it's not gonna lose as much. But if the longer expiration date, the less the option will change value based on its price in terms of how close or how far from the strike it is. So it's basically a mechanism of strike and expiration date working together. So I really suggest you go over this in details, learn it by heart if you wish. Watch some videos where this is explained very well. Now let's go over options basic examples. So options can be bought or sold. Now the most basic thing how people trade options, they simply buy it to resell them. They're not expecting of doing the assignment, which basically obtaining purchasing a stock at a strike price. They simply buy them depending on the expected market direction to resell them. Basically, pure speculation. There's a nice graphs I kind of here in pictures for each basic option. Hopefully it helps. I try to add as much information as possible and not to make it too much. So a call option is for when you expect the market to go up, you buy calls, market goes up, you sell calls. That's it. I include live examples here, so with details. So if you wish to, review that yourself. Um, Now you can buy calls and you can sell calls. Uh, so similar approach. It's just if you're a buyer, you really expect for it to go up. If you're a seller, you kind of depends. It's okay for you if it goes up, and it's okay for you if it goes sideways. So I mean, the catch here is when you sell options, you can sell them naked, basically, without covering with stocks, as each contract, each option contract, is has to be covered by 100 shares of a stock. So especially for something like S&P 500, which is almost $500 right now, for just one contract, you would need 100 shares. And it's $50,000. You need to have cash, basically. But I mean, once again, if you simply, when you buy options, you are not obligated to purchase the stock. When you sell them, you may get assigned if it hits the strike. So you technically can buy your contract out before it reaches the strike. But this is all in details. You can read here. If I'm gonna go over everything, this is gonna be like a 5-hour video. So buying calls, selling calls, same way with puts. You buy puts when you expect for the price of the stock to go down, then you sell them for a bigger price. Same way you can sell puts. Same concept. And there's also cash secured puts, where you basically sell naked puts, but you have cash to cover it. And then there are different approaches. For the most basic one, if you get assigned, you obtain the stock, and then hopefully it recovers. Like if it doesn't go too much down, then it goes up. You can resell it, or you can sell covered calls, or you just sell it and then sell another cash secured puts. All of it is here explained with live examples. So hopefully that covers basics. Now, the other two sections, I include smart approach strategies, which I'll show on the actual. I'll first go over the indicator, then I'll show these, or go over these strategies. And of course, in here you can find all the settings of the indicator with full explanation. So now let's go over the actual indicator. I'm gonna use SPY, S&P 500, and this indicator is best for day time frame because it's best to sell options for weeklies, or for S&P you could do several days. I mean, it's good also for TQQ, for example, as let me hide that stuff. As TQQ is much less, and it's basically if SPY goes up, TQQ goes up, and for TQQ, for to cover one contract, you need 100 stocks. So for S&P, just one contract right now will be almost $50,000 of worth of stock. For TQQ, right now it's almost $60, and for one contract you need $6,000 to cover it, which is a big difference. And it's very similar, but I'm gonna use SPY. The only thing is SPY, you can basically sell. I think you can even sell dailies, but I'm not sure. I'm pretty sure you can sell several days. For TQQ, you probably want to sell like weeklies, but we're just gonna concentrate on weeklies. Let me just go real quick over the indicator Now, there's this warning. There is a problem for some reason, which it seems like it is internal. I have a case open where the dates, as there's a date when you sell the contract and there's an expiration date. For some reason, you have to put input 1 day behind than what it is going to be on the chart. It's not a huge problem, but I hope they can fix it, and you'll see what I'm talking about when I go over um, setting up trades. So global settings is just weekly dividers. It's gonna really help. There's gonna show you weekdays, Fridays and Mondays, as that's the most important days, and they're gonna really help. Like if you want a weekly, you can see from where to where you want to go. You can customize them as needed. It's gonna display Tuesday, like in here when this is a new year. Monday was closed, so it's gonna display Tuesday then instead. Before we get into setups, there's 3 potential setups you can do on the same indicator. Before I do that, let me go over technical analysis tools. There is trend lines. I just rewritten them. They're much better. They're really good. They're gonna show the only thing to keep in mind when it's dashed in here, it means it did not exist here yet. Like this is the pivot point. This is the second pivot point used for this yellow trend line, but it only was established here. So the dots is where the actual line was established. So you would not see it until it started in here with the dots. So it shows breaks. There's alert. You can be alerted when there's a break, and you can configure your trend lines. The bigger this number is, the bigger resolution trend line will be. So more established trend line. If you say you can extend them if you want, but it may get a little dirty, but that's up to you. So besides trend lines, there's support and resistance. Resistance is blue, support is yellow, and there's sometimes, as you can see, like in here, the resistance becomes support. Same way you can show hide breakouts, alerts. Same way you can configure the resolution basically of your support resistance lines. The bigger this number is, the more established the support resistance lines are going to be. Like the stronger the levels are, similar as trend lines. And just a good old moving average. You can see it right here. It's this line. You can choose SMA, EMA, WMA, and ATR. And this is just the table stats for each setup location. So let's go ahead and use the first symbol. Now I set it up in here because you can set this up on different charts, and then on the stats table you're gonna still see correct numbers. So yeah, you can set up a couple stock. You can set like one for stock, one for another, one for index, and in the stats table it's gonna show you all the correct numbers. So as otherwise you have to be on the correct chart to see the actual visualization of each covered options setup. So this one, for example, yeah, let's start with this example. For example, this is Monday, and I decided to, it seems like we bounced off the trend line. It seems like we're bullish, so I want a covered call. So in here, it's best to purchase this, open a trade at the end of the day. So at the end of the day, the candle bar would be here. This is 492.51. Let's see, 492.81. This is basically where I would approximately buy my stock. 56. This is where I would buy my stock, as this is a covered call. We're gonna do one contract. So this is the price you would purchase the stock. Now this is Monday, February 5, and in here you want it to be February, let's see, 4. Yeah. Which is, as I mentioned before, it's one day before. If I said 5, it's going to be one day ahead. So it's a bit annoying, but it's not a big deal. Hopefully they can fix it. So let's do 4, and that way it's going to be February 5. And for example, I do it weekly until next Monday, which is February 12. So in here, it's going to have to be expiration. You can set 11. And now you got your weekly options set up. And the strike, for example, let's choose whatever. Let's leave 496. You choose 496 strike. So right away, you can see everything here. We choose one contract, which you can also choose here. Let me go over this real quick. This is a symbol. You can completely turn it off, and it's going to be gone. Everything is gone. And you can hide table. Now labels are these labels. All of the label size, the label color. There's a text color, and basically you can hover the mouse here and see exactly details of each setting. So this is not just label color. This is basically color of everything. I'm gonna rename this. This is the lines. This is basically a color of your whole symbol. Yeah, so let's switch it back to white. Same way it's gonna show you here on the table. So it's not gonna, you're not gonna get confused. You're gonna see your color here. Now in here you're gonna choose the approach. It's covered calls, covered puts, or cash secured puts. We want covered calls here. In here it's a brief explanation of each, so you can always review it. We're gonna do one contract, which you sell at bid price, which is here, price per one contract, bid. You may get confused. It may get confusing. There's bid, there's ask. You buy options at ask, you sell at bid. This is a bit too high. Usually 3 days, it will be something around, I mean, a week, maybe around, let's do just 250 per contract. We got our strike, we got our stock purchase. These are all you're gonna have to input. You set the dates, and pretty much that's it. And here is just if you want to alert at expiration, it will alert on the actual expiration day. For S&P, I believe it will be, there's an explanation here as it might differ. For me, when I was testing S&P, it alerted me at 9:30 a.m. Eastern time. So in the morning of expiration, it's gonna alert you, hey, this stock of your setup expires today. Now the other two things is there's strike, which is dashed line, and there is break even, which is dotted line. You can either I mean, if they crossed, if they're broken, it can either be that by closed candles, candle has to fully close, or it has to touch it live. So as you can see, I mean, this candle is not closed yet, as this is a daily candle. So if it's live, immediately when it would start crossing the strike, similar for break even, if you choose live, same way if you, for alert. In here, first you can show or hide it, and you can alert. If alert is set at live, immediately when it starts crossing it, you're gonna be alerted. If it's set to close, this will alert once this candle closes, which is gonna be I don't know for S&P. It could be in the evening or in the morning, but it depends how you wanna go with it. So that's pretty much it. Every other setup is the same way. You have three of them. Um, so let's go over this one in for table stats. You can see this is our symbol one. We have the color. There's a style, covered calls, one contract. This is our bid price, which we set to 250. Now this is the premium per contract. You would receive $250 when you sell this contract. This is total premium in case you're going to use more than one contracts, and this is premium plus a live profit loss. Let me explain what the live profit loss. I mean, in covered calls, you purchase the stock, so and you at the end of the trade you will sell out if you get assigned, especially, and for this one we'll probably get assigned tomorrow, but I mean, not it's not guaranteed it will, but if it goes far, it will. It doesn't mean it's gonna get immediately assigned. If this candle would be right here, or we would set it the expiration date for today, overnight you would get assigned, and you would get assigned at a strike price. So what this shows you is the difference in profit for selling the stock from the purchase price $492.56 to $496. It adds that profit to your premium profit. So if this would close right today, you would receive $594. If it's gonna be below, let me actually show it. Like if it's gonna be below strike, let's set strike for 500. For 500, this is a bigger number now, and it's gonna grow until it hits strike. If it goes beyond strike, it's not gonna grow because you can only get assigned at the strike price. But it's nice to see here like how far you're in, and depending on the covered options approach, this may be very helpful. So stocks required. This is how many stocks you need to accrue. This is stock purchase price, and this is the total. This is how much you would spend. This is your strike. This is break even. This is the dates, and it shows you how many days left. If it would be still active session, like or the morning, and the expiration date would be on this candle, it would say here expiring today. I believe it's not gonna, what is it, February 7th, 6th. I don't think it's gonna do it right now. Let's double. Yeah, it does. It still does because the candle is open. You're gonna see at expiration day, it's gonna show you this nice label, expiration, and it's gonna show here expires today, and it shows you expiration days and how many days left. Let's switch it a bit ahead. So what's nice here is you see your options covered call completely on the chart. You have the full visual. Now, what does break even mean? If, for example, the stock would go down and we have covered calls, what this number means, break even, $490.06, if at expiration, right here, a candle closes exactly at this number, and you get assigned, since you received $250 premium, that difference in stock, because basically you're gonna sell the stock less for what you have purchased it, that difference basically makes it break even. So if it would be sold right here when it expires, you would not lose anything, you would not make anything. Now obviously it doesn't usually happen like this. It may close a little below, or a little above, but this is basically, this is what can be used as a stop loss. And this is, we're slowly moving into the smart strategies developed specifically to use with this indicator. So let's go ahead and go over them. This is what the strategies you would find. So this is smart covered calls. So the approach is you open a trade based on technical analysis. In here, it's simply, I don't know, it's bullish. There's no special here. I'll show you a bit more specific setups in a bit. So yeah, confirmation. This is the example. Now take profit. How would you take profit? For covered calls, it's best. I mean, it's probably the only way for you to profit. You either wait till expiration, and if it expires and it never reaches the strike and it never goes below the stock purchase price, you basically got your premium, $250. And if it's a little, yeah, that's it. Then you can sell another covered call. The other is assignment. If you're assigned for covered calls, it's good because I mean, the only it's not loss, but this is what you could have get. Like if it closes by expiration somewhere like in $508, you would probably make more money simply buying and selling the stock. But it rarely goes that far, and basically options is reducing your stop loss while making it more flexible. And if it doesn't go anywhere, just go sideways, you still make profits from the premium. So let's further continue. Now, break even stop loss, that's basically how I named it, BASL. This is the formula, how it's calculated, just in case you want to know. Now, just like it says here, if it's stock sold at a slight, if it hits the break-even stop loss, let me get back to the chart. This is what I already explained. If it's, if for example, it hits that before the expiration, now, and if you want to use it as a stop loss, let's do now a live example. Basically, if it closes here, for example, it closes here slightly lower, which is fine, and you want to get out of the trade. If you would simply open the loan, but simply purchase the strike, purchase the stocks to go long, you would have your loss. And if it would be exactly at this spot, it would be exactly $250. Now, since you already got your premiums, if it would happen at expiration, it would be zero. If it would happen before expiration, that contracts are not expired yet, and they would still have a price, some sort of a price. They would still cost something. However, they go in here. They would go against themselves, basically, because it's close, and if they go down and time passed, they'll be much less expensive. So they could be, for example, $100. So the point in here is you would buy them out, basically buy your contracts back. You not would like own them, but you basically, that's how you close the trade. You buy them back, and you would still have your $150 because you would pay $100 to buy them back. You would sell your stock. There would be a loss, but not $250. It would be slightly less loss. So this is why this is a sort of a smart approach, how you would back yourself up with this options, covered options. And yeah, not only it covers your stop loss or reduces your stop loss, it it also increases your profit potential. Now, I mean, for covered calls and S&P, most likely, if it's not like breaking through like this line or goes below moving average, you probably be safe just letting it expire, and you would be in the loss, and you can just wait a little, or I don't know, sell a covered call with strike just above your stock purchase price. You would still be fine. But why would you do that? For example, if for any reason it just starts falling down, and for example, like it did in 2021, I believe, and it was down, it came back like a week ago, so you would be stuck for 3 years. So you would not have to take this one stop loss, but you would be stuck with a liquid stop loss or unrealized loss for a long while. So that's why it's a smart approach. Hopefully that makes it clear and understandable. So now let me just show covered puts, which basically is the opposite, like a mirror of this. It's more dangerous in terms of there's more potential loss. Could be, well, actually it's not. I mean, it is a bit more risky, but yeah, you'll see. So I think I already have them set up. So let me just turn them on. So here it is. I'm gonna go do it one by one, so we're not getting confused. This one is a bit more advanced of how would I trade it, for example. This is a covered put. Now, as you can see, there's a trend line. It comes from a long time. It's established trend line. There's this huge red candle. Then there's a retrace, and then there's another candle closing below that trend line. You can see B trend, which yeah, orange means it was broken down again. It came back and then it broken again. So you expect, for example, a bounce or retraced, and as you see, it was pretty heavy retracement. So this is how you would set this up. Let me just hide everything. So let's see. So there's a trend line. It's broken. There is a retrace, testing, and there is another break. It's a green candle, but it's actually dodgy, and it does close below that trend line. So potentially there could be a down move, which then happens. And same way, just like with covered calls, the difference here is you're not purchasing a stock, you're shorting the stock, and that's a big difference. And that's why puts or covered puts can be more risky, because if you purchase the stock, you can just wait it out, even if it's 3 years. If you short the stock and it never comes back to this point for some reason or for any reason, your trade, your loss will grow not exponentially, but it's unlimited. So there is no. It would be very bad approach to just let it go, If the stock goes up and you just, maybe it will come back, maybe it will, maybe it will not, and same way it may come back in a couple of years. You don't, or maybe it will never come back. So that's why the smart approach, it's built the same way. There is a break even. There is now it's upside down because we're going down. You can see these arrows I added. It helps seeing exactly where we're going, what's our sentiment. So similar, you would you would short your stock here at $456.47. This would be your break even. This is your strike, and the strike you're gonna have to choose manually. But in here, you can see there is a trend line, and there is a what is it? I think it was resistance, but now it became support. So there is a trend line, there is a support, there is a moving average. Now, why would you want to set your strike above it? Because Now it did not do it here. It could easily bounce and just come back, because there's a lot of resistance here, or I'm sorry, a lot of support here. It did not happen, but you know, better safe than sorry. So in this particular trade, it would be a great trade, as actually, unless you would get assignment here, I don't think you would. That usually never happens. This would be simply, you'd simply get your premium. That's it. Oh, I'm sorry. I'm sorry. It's not that you were shorting. You would not get assigned. But what I would do here, once contracts expire, I would get out of this trade, because it's a short trade, and I would wait what happens next. It tried to bounce, but it goes down. In here, you could open another covered put, and you see it would play out pretty good. But that's what's good with this whole indicator. It shows you these, once you set up these levels and you appreciate them, there is no, oh, what if I do this? What if I do that? You just follow it. You got a system set up. The only thing this indicator lacks, you will have to choose your own direction or sentiment. And for that, you can use, I included specifically the very basic things: trend lines, support, resistance, moving average. You can use ATR as well. But yeah, once you set it up, you set it up. So one more thing important, I want to go through break even line. How do you establish it? Now for smart covered puts, let's see, BESL covered puts, break even on stock purchase price plus bid price. So technically, the bigger the bid price, the further away your break-even line is. Let me show you what I mean. Right now, our bid size is 265. If we're gonna set it to 3, see how this line is gonna go further up. You see, if it's 5, it's gonna just go really up. But now the bid price is not something you control. It's what's available. This is what you see when you buy or sell. When you buy options, you buy it at ask price. When you sell it, you do it at bid price. But this number is not controlled by you. But how would you increase it? Now, in order for this number to go up, either the strike has to be closer, because I'm not gonna go into why, but that's how it works. You're gonna have to trust me on this for now. The closer the strike is, the bigger the bid will be. So, but you don't want it too close, because you would miss out on a good, nice move. Like you could set the strike here. It's not gonna change here. Like if I change the strike here, it's not gonna automatically expand the break even. Break even will only expand or go further away if you change the bid price. However, when you will be selling the options, if you choose a closer strike, the bid price will increase. So again, to increase the bid size, you can do slightly closer strike, or you could expand the expiration date. It also increases the it also will expand the break even. However, with a further expiration date, first of all, you have more chance of something going wrong. Like it may, if you choose like an expiration date for several weeks up to here, let's pretend our expiration date is until like here. Okay, here, like this side weekly divider, and in here it goes up. You would lose out on all of this potential. You know, there's the more time. I mean, time is not working in your favor when you sell options. I mean, it does, but you don't want it to be overly extensive because it may go another way. So yeah, you don't want to choose just too far away. Now, besides time, yeah, so just few things to go over. Yeah, if you want to raise your bid, your break even, this works the same way for covered calls. All you have to do is increase bid size. In order to do that, you choose closer strike. For puts, it's going to be closer up. For calls, it's going to be closer down. And you choose further expiration date. Like if you add up another week or a couple of days, and as long as it, like you see in here, it's right above the highest high. So this is, and it is behind this trend line, with the broken trend line. It is above this candle, so it's good. And then you see the resistance appeared here, but it only appeared later, like at this candle. So this is the covered put, a smart covered put. Now let me go over cash secured put. And I did have one set up here. Now there is no purchase or shorting stock or anything here, because when you sell cash secured puts, you just sell contracts. You're not buying anything, you're not shorting anything. But that's why it's called cash secured. You must have cash to secure it. And in here, you would basically sell the contracts at this candle. And why would you do that? Well, the resistance was just broken. It's still above the trend line. The trend is up. Whatever, let's just do it. Let's go for cash secured put. And if you can see it worked well. Also, we're above the moving average. We're bullish. So the strike is below because this is a put. So it is in your interest for the price to never get below the strike, or even worse, go below break even. Now let me open it real quick here. Smart cash secured puts. Let's see, there is a break even. First of all, here's a formula. It's strike price minus bid price. So once again, that break even, if you want to make it bigger or further away, increase the bid size. Now how it works in terms of like what are the outcomes, what can happen with this trade. Now take profit. Best scenario, it expires. It goes sideways or goes up or even goes down, but it never reaches the strikes. You just keep the premium. You're good. Now what else? There is one thing different about cash secured puts from covered calls and covered puts. If, for example, like right here, somewhere would be a big trend line or big resistance, and for example, like there's one more day until expiration, and in here, even at this candle, look at this huge red candle. Even with this candle, we strike so far away. The options contracts could be easily, the price would reduce by 50% easily. So here's your premium, and at this point, for example, they are costing $150 or $125. That's for ease of calculations. So what if next day, I mean, it's not probably the best example, it's still too far, but if you would be closer, you strike, let's change the strike actually, so it's going to be easier to explain what I'm trying to show here. Let's pretend our strike was 451. So let's pretend we sold it at this strike. Now in here, even with strike closer, it could still be 50% less because there's one more day left. Will it get here? Maybe. Maybe not. I mean, it would be best to just let it go. It would expire. But after this candle, next day, it could go like up to here. And you don't want it because you would get into loss. So you could buy out your contract at 50%. So basically, you receive $225. You pay that $125, which it's currently cost. That way you still keep your $100 and you're out of the trade. And I mean, that's really depends on technical analysis. It's best if it, even if this would be a green candle, but in here would be like a trend line or a resistance, just do it, you know. You can then wait, see how it goes. You have like a break here, and maybe, you know, there's a break, like our previous example. There's a setup for a covered put. So you just go, you would sell out here. Yeah, you may lose potential $100, but you would be safe. You still got your profit, and then here you just go for a covered put. Let me hide it. So, yeah. Now, and so the third outcome is assignment. If this candle closes like right at the strike, right at the strike, very close, somewhere over here, you got assigned, it's best to get rid of the stock. You just get rid of the stock, and then just sell a lower strike, you know, unless a trend unless there's a trend change or something. Like if it's still, if it would bounce here, for example, sell like sell another one, but you would be out of the trade. Now if it got here to the break even, like at this point, there is still a way to go, but it seems something is going wrong. It's not going the way we want it, and you just want to get out of the trade. For example, it closed like right in here, barely breaking the break even. You can buy out your contract, but this is now going to be a loss because this is puts, and if it would get right here, it could easily be another $100. So to get out of the trade, now the contracts are costing $325. So you use your premium basically to plus the $100 of loss. So you'd have to pay $325 to get out of the trade. Yes, you lost $100, but what if it would just fall down, you know? And if you would not get out of the trade and you would get assigned, you would get assigned at the 451 strike. So this is basically where you would buy it. And the stock is already somewhere over here. So now you are in loss. It's a liquid loss, you know. It's unrealized gain. But what if it just falls down and like continues falling down? Like look. So this is a good example. Well, no, in here it's not good. It came back. You could have easily sell it here. But what if it would not? This is August. This is 6 months. You would get the stock and for 6 months with this stock. But this is S&P. So I mean, this is really up to you. But this is something I came up with. I don't know if it's already out there, but I have not seen it. So I don't know. This is why I came up with this idea, with this indicator. And I mean, you could do it without a chart, but it would be really hard. In here, you see exactly where is your break even, where is your potential take profit, or you have your table. So it should be much easier to trade covered calls, covered puts, basically covered options. There is one more strategy, which is wheel strategy. This is nothing new. This is a combination of covered calls and cash secured puts. For example, if you would get assigned, let me switch this off. If you would get assigned here, for example, like you would not buy your contract out, you just get assigned. Let's do it. Let's see, what is it? August 4. August 4. I just want to show. There you go. You see all the strikes, all the break-evens, and you can set alerts to be notified when this happens. So let's pretend you are, let me do one more day behind. You get assigned here. Now, when you get assigned here, you basically purchased 100 with one contract. You purchased 100 stocks of S&P at $541, and the stock right now is at $446. So you're basically in loss right now, but it's unrealized loss. So you just right here you immediately you sell a covered call. Let's do it. So here I set it up. So in here you sell covered call immediately, and as you see, this stock purchase price is not here because you technically purchased it at $451, and let's say you choose 455, and that way you still hold the stock. You would get your premium, $250, and it would simply burn, which is nice. But in this case, it would continue going down. So it got even more down. But it came back here again. What are you going to do? Sell another covered call. What is it? And there it is. In here you sell another covered call. You're still at 451, and it still just burns down. Now what can be the problem here? Like in here, for example, you probably won't have you won't have any good covered calls expiring soon for such far away strike. The price has to be closer. So you would basically wait. I mean, because if it's gonna be like $20 premium, there's no point. But you see the price came back. It came back here. Sell another covered call, and that's why it's called a wheel. You just keep going around and around and around. Once again, what can happen is, and you can see it here, it can go down, you can get stuck, but you're stuck with if it's S&P, that's a good index. So at this point you may have get stuck for a couple of months, but then you would come back. But you would almost always constantly receive premiums as profits. And with covered calls, it can also be a stock price difference. So yeah, hopefully that covers everything. If you have any questions, please ask in the comments under the video, or please contact us through the contact form. And trade responsibly. Thank you.